And I want to take a moment to introduce two people who will be presenting tax consequences of general interest. They will be presented by tax attorney Bill Marino. Bill is pretty close to Morgantown, so his WVU pride will probably be showing through, and my tax partner, Don Johnston. So with that, please welcome Bill and Don.
Paul, how's my sound? Am I on?
Test. Good?
You're good?
Check, check. Good.
Am I good in the back, everybody? Good morning, everybody. Thank you for coming. I will have to say that, one, we're happy to have you here. And a day and a half ago, my presentation was pretty much not even important. Really didn't matter. Nobody was going to care. But as we know, everything changed Tuesday at about 4 o'clock in the morning. Bill and I had our slides done when we left the office Tuesday about 5 o'clock. I actually went to the Penguin game, so I was kind of not paying attention. I was paying attention to Sid Crosby, not other things going on. Things significantly changed Tuesday night. Like I said, our slides were done. 4 o'clock in the morning, I got up, checked my phone, and realized that the entire presentation that we put together and planned had to be changed. I sent an email to Mary Lou at 4:45, and I said, okay, this changes everything. Slides need to be changed, and at 5:15 she responded. She says, yes, I know, I've already started. And that is true because the slides were somewhat changed before I even made it into the office. And so make sure you give Mary Lou a huge slap on the back because what she does for us for this presentation is just unbelievable. So, things we're going to talk about. Summary of the elections and the potential tax ramifications. Bill's going to talk a little bit about the Affordable Care Act, and then we're going to close with some general ideas and thoughts in a down year. As a result of what happened on Tuesday, this really flipped. We were planning on spending a lot of time on bullet point 3, but now we're spending a good bit of time on bullet point 1. You'll note that in some of the slides, you might look at it, and when you read the book was written 2 weeks ago. Our section, our chapter was written 2 weeks ago. So at that point, it was still somewhat impartial as far as who was going to win, what was going to happen. So you'll see a lot of generic information in there. The slides too. The slides are more generic now than they were before, and they were somewhat generic when we first wrote them. But you will be able to tell some of the bullet points that things changed, and it'll actually be interesting to talk about. Please note that if we make comments about one particular candidate and you don't like it, there's probably another slide coming up about the other candidate that offsets the first one. So if you decide that you want to boo, hiss, throw things, stand up and call us buffoons, please wait until the end of the presentation before you do that, when Bill is speaking and not when I'm speaking.
I'm fine with that.
Every 4 years, we like Bob said earlier, we do this presentation generally a couple days after Election Day. So every 4 years, we kind of like to give an update of what's going to happen. So I get to recycle some of my slides from 4 years ago, which is kind of nice. And I always like to start every 4 years, I like to start out with interesting statistics and things I find somewhat fascinating, somewhat disturbing at the same time. The 2016 presidential election, and this includes the congressional races. It's anticipated that there was about $7 billion spent. I have no idea where that number comes from. It was on the internet, so it's got to be right. My slide from 4 years ago, that number is only $6 billion. Big, big dollars. I think we might be able to use our dollars better. I'm not sure, but my guess is we can. Pennsylvania, the Pennsylvania Senate race, highly contested. They spent about $75 million. Plus or minus $10 million. At the end of the day, does it really matter? It's a ridiculous amount of money. What we found from that election is if you've ever been on Wall Street, it's a bad thing. If you're not the first person to go to college from your family, that's also a bad thing. It's hard to understand who writes these advertisements, but it gets to the point where they're somewhat ridiculous, making accusations about things that really don't matter and not really paying attention to what the facts are or what really matters. Let me read this slide, how I was going to present it initially before Tuesday. An August survey from the New York Times concluded that 67% of registered voters don't trust Hillary Clinton. It's hard to believe she got elected president if 67% of the people don't trust her. Now the comment is, well, of course she didn't get elected president. 67% of the people don't trust her. So that slide, I left it in there, just changed how we discuss it. Here's a great one. During the 3 presidential debates, Donald Trump told 137 lies. So what's the over-under for how many lies you can tell before you can't be elected president? Apparently it's over 137. Famous person, great philosopher, once said, his name, Sir George Costanza, said, if you believe it, it's not a lie. So there you go. Many negative statements brought out against Mr. Trump over the last 6 months. Many myths, if you will. Many things that don't shed him in the greatest light. And I just want to talk about a couple of them that may not be true. No, that one's true. No, that one's true too. How about we talk just from a tax point of view? During one of the debates, Secretary Clinton said, he pays no tax, which makes you think that he must be a bad man because he pays no tax. And when she said he pays no tax, he said, it's because I'm smart. Right? Remember that? Remember that? Well, that was a lie. The reason that was a lie is because Donald Trump was not the smart guy there. His tax preparer is the smart guy. We could have got some serious love right there, right? And we got nothing. And for that, I will always hold that against him. Now think about it. The problem is not that millionaires, well, the problem is that some millionaires pay zero tax. That is a problem. But that's not a Donald Trump problem. That's not a Mitt Romney problem. And that's not a Hillary Clinton problem. The problem is that the tax code is so screwed up that we can have a situation where you have a millionaire, and Donald Trump has boasted about being a billionaire. You have somebody like that that pays zero tax, which tells you that there's something very wrong. And the problem is with our tax code, not with the tax preparers like myself, who work really hard to make sure, I get paid, that's how I make a living. A lot of you folks pay me to keep your taxes as low as possible. How many of you, I don't remember, but how many of you, when I give you your tax return, or the business tax return, how many of you give it to me and say, there's $10,000 of tax here. The total tax liability is $10,000. I don't think that's high enough. I think it should be $12,000. I think it should be $14,000. That doesn't happen. That never happens. So why would you think that Donald Trump would do something different? The problem, again, is the tax code. So let me tell you, 30-second story. How do you get to the point where, as a millionaire, you pay zero tax? How do you get there? Let's assume I start a business in my garage. Started in my garage, and I invented Post-its. I invented the Post-it. Started in my garage. 10 years later, I sell my business. Somebody buys it. $150 million. They stroke me a check for $150 million. Current tax rates, I'm paying about $50 million in tax. I end up with $100 million in my bank account. I take $50 million, set it aside. I'm going to keep this. I'm going to live on this forever. I'm going to pass it on to my kids. That other $50 million, I take it and I invest it in a business. And let's assume that my business is self-driven motorcycles. $50 million, self-driven motorcycles. After 2 years, I lose $50 million. Completely lost $50 million. Lost all of it. So from a tax point of view, what happens there? That $50 million, I have a $50 million tax loss, which I get to either deduct that year if I have $50 million of taxable income, or I get to carry it forward for 20 years, unless I use it before then. So in year 3, I'm a millionaire, and I have a $50 million net operating loss that carries forward, and I don't pay taxes for the next 10 years. So that's the situation that a lot of real estate developers are in, like Mr. Trump. And I'm not trying to defend him, I'm just trying to tell you how that happens. Because I have several millionaire clients who do not pay any tax because they have these huge net operating losses for investments that have either failed or businesses that have failed and kind of carry forward. So that's the situation that I see. Like I said, I have a handful of clients like that, and we're consistently planning about how do you use that as net operating losses going forward. The key point here is that you don't invest $50 million in a business to lose $50 million so you can take a tax deduction of $50 million in the future, right? You don't want to take a tax deduction that's going to save you 40%. You don't spend $50 million to save 40% of that in taxes. So to have a net operating loss, you've had to lose money, which even business owners like Mr. Trump are not in the position where they want to lose dollars. So it's kind of a timing difference. So the point here, paying as little tax as possible is not a crime as long as you follow the tax code. Here's a good slide. This slide was better 3 days ago. How many of Donald Trump's tax returns would be audited now that when he lost the election? The answer was all of them. And now that he's won the election, it's none of them. So it'll be interesting to see if we ever get to see one of Mr. Trump's tax returns. I would love to see one of his tax returns just to see how it worked. I've actually reviewed several of the Clinton tax returns over the last couple of years. And you know, there's really nothing of any surprise on there because we've all heard what's on their tax returns and how much money they make. This is one. This presidential election ruined this quote forever. Does anybody know what the answer to this is? In this world, nothing can be said to be certain except death and taxes. Does anybody know where that quote came from? 300 years ago, 1716, a writer by the name of Christopher Bullock, in his book, The Cobbler of Preston. Yeah, I'm a tax geek, right? The Cobbler of Preston. This was in his book. And all of a sudden, we can't say this anymore because it's not certain. You can get away without paying any taxes. Our president-elect just showed us that, at least for a specific period of time. So we can't use it anymore. I kind of like it better that you can say death and taxes because when you just say, in this world nothing can be said to be certain except death, it doesn't sound as enticing. It doesn't sound as good. I'd rather have something else to say. So where are we going from here? This is the current makeup of Congress. Republican controlled, we know that. The Senate's controlled by the Republicans. The House of Reps controlled by the Republicans. We have a Democratic president, so there is some type of balance. Congress passes a bill, gets up to President Obama. He says, I hate it. I'm not repealing the Affordable Care Act. Veto it, goes back down, and it never makes it through, which tells us that's the reason that over the last several years that nothing has been achieved in Congress because you have two opposing parties fighting and nothing happens. When the Affordable Care Act was passed 6 years ago, President Obama controlled the Congress. He had the House and the Senate, all three pieces controlled by the Democrats, and we got the Affordable Care Act. So what happens now? Now, with the recent elections, the Republicans control the House, Republicans control the Senate, and now we have a Republican president, which means that tax reform and other items that have been promised by Mr. Trump are very likely to happen. Now, everything that he said may not happen. There are some controls there. We do have a Speaker of the House, Paul Ryan, who's trying to continue his career as a politician. So there are some controls there in place, but nonetheless, we still have a Republican Party that very likely will be making some significant changes in the future, including tax reform. The president does have the ability to veto anything, so as Mr. Ryan gets things through Congress, doesn't mean that President Trump is automatically going to sign it and be done with it, but definitely something to think about. This slide, future tax policy is uncertain. I didn't change the name. It was very uncertain before. Now it's still uncertain. We just don't know what the certainties will be. We don't know what the actual changes will be. Chances are very good, though, that changes are coming. Tax law, tax reform, is it really going to happen? I've been doing this presentation for 16 years. This is the first time I can actually say it's really going to happen. We don't know how it's going to happen, but I can't imagine that we don't have tax reform at some point in the near future. So I have a couple slides here just talking about President Obama, or I keep saying that. President Trump, well, it's really hard. President Trump's plan that at least he talked about during the election. So let's talk about a couple bullet points. Reduction of the tax rates, and these are individuals. Reduction from 7 to 3 tax brackets. Again, he's trying to get simplicity. Reduction from 7 to 3, with the highest rate, 39.6%, being reduced to 33%, and the lowest rate of 10% replaced with the bottom rate of 12%, which means lower taxes on the wealthy, higher taxes on the folks down at the bottom. Adjustments to the top rates on dividends and capital gains to 20%, and then the elimination of alternative minimum tax. I think I'm going to get laid off if they ever get rid of alternative minimum tax. That's one of the things that I talk about every year. At least maybe I won't be able to. I won't have to speak anymore. Elimination of all Obamacare taxes, capping itemized deductions, and then this stuff is all just plans, things that have been talked about. So it's not necessarily going to happen. The very bottom one, elimination of the estate tax. Wow, that's pretty big. I bet you our business valuation folks have something to say about that, because that changes how they do. Changes the need for valuations possibly going forward. So that's very important. Some business tax changes, very important. The United States is third highest in the world for corporate taxes, corporate tax rates at 35%. The plan under President Trump is 15%. Significant changes. Whether it all actually ends up there is questionable. And then reduction of tax rates on all businesses, which S corporations, partnerships, any flow-through income, again at 15%. That one's been disputed because it was so vague when he had that in his plan that it's disputed as to what that really means. And then elimination of Section 199, potentially. A couple other things, immediate deduction of the cost of asset acquisitions. So no more Section 179 bonus depreciation, you just could write off everything. You don't have to worry about those specific limits. Elimination of interest expense deductions for asset acquisitions, possibly. And that's basically not going to let you double dip. If you get the first bullet point, they're not going to give you the second one. If you get to write it off immediately, they're not going to allow you to deduct the interest. And again, still things that may or may not happen. And elimination of carried interest benefits. Okay, so what do we need to be concerned with now? We're sitting here November 10th. We've got 40 days left in the year. What should we be thinking? What are we thinking about that we weren't thinking about 3 days ago? How about the timing of income and expense recognition? Let's assume that tax reform does happen, and in 2017 there's major tax reform. Here's what we know right now. In 2016, the tax rates aren't changing, right? They are what they are. Going forward in 2017, there's only one way. They're not going up, they're going down. So we start thinking now, okay, do we need to be thinking about 2017? Yes. Do we think about deferring taxable income from this year to next year? Absolutely, right? If we can move it to next year, we want to move it to next year. In most situations, have to think about it. The other thing, deductions. We want the deductions in 2016 versus 2017, so we should be accelerating deductions to the extent possible to this year. So timing is very important. We have a lot of work to do between now and year end. And the other thing that's important is we really don't know what's going to happen in 2017. It's probably going to be something. We don't know what it's going to be. But we need to be thinking about it. Timing of capital gains and or losses. Again, something to think about before year end. Do we want to defer? Do we want to accelerate capital gains to this year, or do we want to accelerate them the next year? We think the capital gains rate based upon the plan is going to be the same. But if we defer them to next year, we might, let's assume we've got $1 million capital gain and we're an individual. First off, good for you. That would be nice. But the other thing is if we have that $1 million of capital gain this year, we're reducing our itemized deductions. Where if we move to next year, we may not have to reduce our itemized deduction because itemized deductions can change dramatically next year. Timing of fixed asset acquisitions, let's buy it this year versus next year. If we can depreciate it all this year, let's move it to this year. AMT considerations, very important. If we're an AMT this year and we were planning on being an AMT next year, it really doesn't matter what year you pay your fourth quarter estimated tax payment. So why pay it this year? If you're not going to get a deduction for it, why pay it? We don't know what's going to happen next year, but we know we're not going to get a deduction for it this year, so maybe we do move it. And this one, please don't write on your form that this was insensitive. This comment that Don made was insensitive. I know it's insensitive, but I'm going to say it anyway. Life planning. And this goes to the comment that the estate tax may not be here at some point in the future. We know the estate tax is in place right now. There is an estate tax. May not be an estate tax next year. So you're sitting at a Christmas table, and 96-year-old grandma wants that third piece of cheesecake. From a tax planning point of view, and that's it, we want to make sure Nana's around next year when there's no estate tax. Please don't write a comment on that one, please. I implore you. Considerations for already planned transactions. Let's assume I'm a business owner and I'm going to sell my business. Okay, I already have a plan and we're going to close on December 20th. Whatever the size of the business is, we're already going to sell it. Does what just happened change whether we want to sell that business this year or next year? Well, quite possibly, right? If we're the sellers, do we want to defer the closing until next year to get better tax rates? Let's assume we're a business and we have a lot of income recapture, which is going to be ordinary income. How about we move it to next year? Because the tax rates may not be 39.6%, they may be 15%, or they may be 20%. Again, we don't know. What we do know is this year what the tax rates are. We don't know what tax rates are going to be next year. So it might make sense, if you can, defer that closing until next year. Or does it make sense to accelerate the closing to this year? Let's assume we have a loss. When we sell that business, we have an ordinary loss in that business. We might want to accelerate it from 2017 to 2016 because we know what the tax rates are this year. We want to take advantage of those rates. And the carried interest rules. President-elect, still hard to say. President-elect Trump says that he's going to get rid of carried interest. Whether that happens or not is one thing, but maybe it makes sense to accelerate that closing to this year just so you make sure that you get those carried interest benefits, which are capital gains rates. And from a buyer's point of view, I can't think of a whole lot of difference whether it's this year or next year, but perhaps it has something to do with the interest rates. We know what the interest rates are now, so if we're out there buying, maybe we want to lock in those interest rates and buy in 2016 versus 17. A couple issues facing problems for the Internal Revenue Service. I'm not even going to talk about this because I'm running short of time. The only one I will make a comment on is the very last one, a new tax laws coming as a result of the GOP takeover. If we have significant tax reform, the Internal Revenue Service might just blow up. I mean, they don't have enough people to do what they're doing right now, and if you throw a completely new tax code in front of them, it just may just disintegrate. It would not be good. And before I hand it over to Bill, Bill's going to talk a little bit about the Affordable Care Act. A couple interesting facts specifically about the Affordable Care Act. Okay, the number of times Congress has voted over the last 8 years to repeal the Affordable Care Act. Anybody? 60 plus, over 60 times they've tried it. And that's, you don't have a president now to veto that. The amount of money Congress has wasted, I'll say wasted, I'll come back to that. The amount of money Congress has wasted trying to repeal the Affordable Care Act, $85 to $100 million. Now, it was wasted before, but now maybe it wasn't wasted because you think, okay, over the last 6 years as they've promoted this, got to get rid of it, got to get rid of it. Maybe that is a reason that the election has turned out, a small reason. Maybe that's one of the reasons the election has turned out the way they did, because of them constantly pounding the Affordable Care Act. Interestingly enough, I heard a statistic yesterday that many Americans received their increases to their health insurance in October. John, you're shaking your head. It happened, right? So all of a sudden it's, how much? 59%. When did you get that notice?
I got it on Saturday.
This past Saturday? Yes. Think about that. 4 days before Election Day, you get a notice that your health insurance just went up. How much? 59%. So does that change how you vote? Quite possibly. The timing for those health insurance increases was horrible for election purposes. It may not have had anything to do with that, but couldn't have been good, right? And then the likelihood that there will be significant changes to the Affordable Care Act. I'll let Bill answer that one.
Well, thank you, Stephen Colbert. Are you here all weekend, or is that one night only performance? I am going to talk a little bit about the Affordable Care Act, and Dawn called me up yesterday. I get in the office, he goes, oh, what are we going to do? Affordable Care Act, what's the presentation going to be? I said, I don't have all the details, Dawn, but it's going to be terrific. It's going to be great. I'm going to make presenting the Affordable Care Act great again. Don't worry. Two disclaimers right off the bat. Number one, I'm not projecting any kind of political agenda here. I'm going to give you some facts. I'm going to give you some figures. I'll let you be your own Judge Wapner about what the Affordable Care Act is or is not. And secondly, the book, don't worry about the book. If you want to read the book, take it home. If you're having a hard time sleeping at night, don't worry, it's better than Tylenol PM. It'll put you right to sleep with all the details that are in there. 3 things that I want to do today. First, like I said, I want to give you some facts and figures. I want to give us a snapshot of where we are with the Affordable Care Act before it may get wiped out. Secondly, I want to talk a little bit about what the price might be if we actually wipe this law out. And if I have enough time, and if you're lucky, since I'm a tax guy, we'll talk about some of the tax provisions that came along with the ACA as well. Starting out though, healthcare coverage nationally, where are we at? For Americans under age 65, currently on average about 10%. 10% uninsured. That was as of April. And then recent study came out, recent report in September, about 8.6%. In Pennsylvania, we're actually doing a little bit better than that. The rate of uninsured under age 65 is about 6.4%. So what does that mean? That doesn't mean anything unless you put it into context. And so we'll take you all the way back to pre-disco era. And if you look back, the uninsured rate was relatively steady between 1972 and then all of a sudden, as we get towards the 2000s, we start marching towards 2010 when the ACA was passed. It's like the steel phantom at Kennywood. It starts going up, starts climbing up, 18.2, and then all of a sudden, when the provisions start coming in, down we went. And that's where we are now, 10%. So when you look at one of the things that the Affordable Care Act was supposed to do, it was supposed to expand the reach of insurance coverage. It was supposed to allow more people to come into the system who hadn't been able to get into the system previously. So when you look at it percentage-wise, yes, we're down at 10%. Maybe it's not doing so bad in that area. What about healthcare costs? Just mentioned, they're going up. They were skyrocketing, though, for a while between 2001 and 2006. And as we'll see, incrementally in the last couple of years since the ACA, they have stagnated a little bit. They've still gone up, but they have stagnated slightly until probably this year. Going back, as you can see, 2001, between 2001 and 2006, average premiums for a family skyrocketed 63%. Now that's compared to, was the rate or the increase there in workers' earnings was about 15%. Overall inflation was about 14%. That was a huge jump from 2001 to 2006. Now, what could have been the potential cause of that? Well, one thing is that the baby boomer generation was pretty big. And as they started to move through the workforce and started to get a little bit older, like my dad was about 51 or 53 in 2001. He's starting to look at the end of his career. He started to have more need for health care. You start to have a little bit more need as you go along, you get older. Now, if you have a substantial population that needs that care at the same time, what's going to happen? Cost of hospital stays are going to go up. Prescription drug costs are going to go up. And then, of course, with all the prescription drug costs and the competition in that market, our advertising is going to go up through the roof. So that's why we end up with a million commercials during Steeler games with 2 people holding hands sitting tub side by side. I don't know what that has to do with Cialis, but that's where we're at. Now, if you look at costs over time, I'm going to take you all the way back to 1999, one of my favorite years. It's my freshman year of college. Where were we in 1999? Family of 4, my dad, my mom, me, my brother. Cost of coverage about $5,791. Between then and 2010, right before the passage of the act, we had gone all the way up, average cost $13,770. That's a big jump. I think I did the math in my head, it's like 137%. So as we started to move through the 2000s and we're getting more people that are getting a little bit older, but they're not qualified for Medicare yet, costs started to go up for premiums. Now we come to the part where the Affordable Care Act starts to come in. We can see that average costs are still going up, but they are incrementally going up at a slower rate than what it was between 1999 and 2010, which was right before the act came into play. So the issue here, though, is that the costs do continue to go up. And where we're seeing that impact the most is coverage for very small businesses for their employers has started to go down because as the costs go up, it's just not becoming feasible anymore, particularly if you're under 50 full-time employees to continue to provide that care. So it may be a better option to go out to the exchange or provide some sort of different supplemental coverage. But that's where we're seeing the greatest impact is those smaller businesses are starting to think about their options or do away with those options completely. Americans, obviously, we're all divided on this issue. It has been for a while, ever since it was enacted. And of course, depending upon what side that you're falling on, it may be more prone to want to get rid of it. As you can see down here for the Trump supporters, about 73% of them in polling wanted to absolutely get rid of it. Everybody that was supportive of Hillary Clinton, most of the people wanted to keep it going. Now, when you kind of smooth that out over the average of the entire population, and you take out who was specifically voting for this person, who was specifically voting for that person, came out to roughly about 32% of Americans actually want to get rid of the whole thing. So that's kind of important because with the new regime in place coming up, sorry about that. Technical difficulties. With the new regime coming up in place, they have something to think about because a lot of Americans do want access to coverage. They do like things like coverage without pre-existing conditions. But there's a lot of Americans who say, but it's costing us way too much at this point. There's too much in taxes, there's too much in my premiums. So we got to think about a different way to do this. So what's the risk here in completely wiping this thing out? Well, the Congressional Budget Office, which is a nonpartisan group that has been set up by Congress specifically to take a look at tax implications of specific bills, did a study in 2015. They looked ahead, they projected 2016 to 2025. If we eliminate this thing today without replacing it, where are we going to be at? Well, as you can see, we'd lose about $1.174 trillion in tax revenues. I mean, that's how we pay for this thing, right? Tax revenues. We would save about $821 billion in costs over that year, just related to the ACA. Net deficit would be about $353 billion. And every time they do these studies, they factor in a little bit of, well, there'd probably be some increase in employment if you cut the tax rates. Maybe there'll be some job stimulus. And so they projected that about 216 billion would be put back into the economy. So net, 137 billion budget deficit if we just cut it today. Coverage. Overall, they projected 24 million Americans would lose health coverage. That's 14 million fewer on Medicaid programs for under age 65, 18 million fewer individuals with non-group coverage, that's the exchange. Then they also projected there'd be about 8 million more individuals who would actually get employment-based coverage if this were repealed today. That's where we get our net 24. So something to think about moving forward is it just enough to repeal it, or do we actually have to have something in place that replaces this? Because this could be a big, big hit to our federal budget and maybe to our economy if we just repeal it. So how do we fund the ACA? Here's the tax piece. Healthcare coverage mandate penalties for individuals and employers. High employment income, additional Medicare tax. I said employment because that's not just employees getting a W-2, that's self-employed individuals as well. It's 0.9% tax on excess or an amount in excess of a specific 250,000 limit. Cadillac tax, which is going to be on high-cost health insurance plans, that's just about dead, even if this thing stays around. And then net investment income tax, that's where we're seeing some of our clients that they have they're making net over 250,000 a year. They're getting an additional 3.8 tax on their investment income, interest, dividends, capital gains, that type of stuff. And then we're also seeing some other taxes on the health insurance providers and prescriptions. Just quickly, because I want to move along to what Don is going to talk about as far as some tax tips coming into this year. Healthcare coverage mandates, we know those have been in place for a little while. Hand in hand. Individual mandate, employer mandate. Individuals, we all got to have health care now. They can't require us to go out and get health care. How do they do it? They tax it. It's a tax. It's the taxation power is what allows them to do this. Employer shared responsibility. Basically what Congress has said is now you're going to have to kick in. You need to pitch in to help get coverage going in the right direction. What do we need to know about the employer mandate? 50, couple numbers, 50, that's the minimum full-time employees to be considered a large employer, which subjects you to new reporting requirements, and it also subjects you to new coverage requirements. 30 hours a week, that's considered a full-time employee. 95%, you need to offer, if you're a large employer, over 50 full-time employees, you need to offer to 95% of your employees affordable minimum coverage. 9.5%, that the employee, to be affordable, the employee contribution cannot exceed 9.5% of their net income that they're pulling in. And reporting-wise, we're seeing 1095-C. You've probably been getting forms personally that shows you what your health insurance coverage was for the year. Those are important. That's something that ties into your personal tax return as well. February 28th is the filing deadline unless you file electronically, and then that's March 31st. So I'm gonna cut it right there because this may or may not be in effect next year. We may be talking about something completely different. But that may not be around, but Dawn's going to tell you about some things that are likely to be around and things that we should be looking at going forward.
Great timing, Bill. Right on the button, buddy. Well
I'd bring
done.
it back.
I know I ran over a little bit, but you did good job on the timing. Okay, so we have about 13 minutes left. The back part of the section, initially I'd intended on spending more time on some of these issues, but since I took so much time at the beginning, I'm going to cut some of these short. The reason I pulled these 6 or 7 items out and put them on the agenda is because these are things that I talk about with clients or potential clients when I'm out there. These are things that I've seen as I'm out there reviewing other people's work, as I get K-1s from other tax preparers. And these are things, some of the things that I've seen with some of my clients and some of my potential clients that I'm talking about or talking to. First, Section 199 deduction. This is a deduction that's allowed for businesses that manufacture product. And one of the things that we see is, one, a lot of manufacturers aren't properly doing the calculation. A lot of CPAs are not properly doing the calculation. This calculation provides a 9% tax break, 9% of taxable income. And it's a pretty significant tax break if you're a manufacturer. And we've seen a few instances where smaller CPA firms or less sophisticated CPA firms are not calculating this deduction. So a note to you, if you're a manufacturer or a processor, you should be calculating this. You should be determining what this deduction is. It's 9% right off the top, which effectively is a 3% difference in the tax rate. Okay, so you need to be a manufacturer or a processor. If you are, check your return. If you don't know where to find on your return, call somebody from GYF. We can help you determine if that calculation is being done first. Is it being done, and is it being done properly? The other thing, like I said, we get a lot of K-1s. K-1s either coming from other firms that are being, the K-1s are coming to individual taxpayers. And there should be disclosure on the K1s if the company is a manufacturer. We see so many differences in how this Section 199 deduction is disclosed on K1s. And we found a lot of problems over the last couple of years. So what we've started to do is ask a lot of questions. When we get the K1, we talk to our clients, say, hey, is this a manufacturer or not? If it's a manufacturer, and we ask that question a lot, because if it's a manufacturer, there should be a deduction. And then we talk to them and say, okay, does this company do nothing but manufacturing? And if it does nothing but manufacturing, the calculation of the deduction is very simple. It's the taxable income times 9%. So what we'll do, once we know that, is we'll look at the disclosure on the K1 in the footnotes, and do the calculation based upon the disclosure, and we should be able to back into what that deduction is. We've seen a lot of problems over the last couple of years with K1s not being prepared properly, and then we need to go back and make sure that we know what the numbers are so we can take that tax deduction. I mean, 9%, 3 percentage point change is fairly significant. Interest charged domestic international sales corps. Okay, it's called an IC disc. Here's the situation. You are a local manufacturer. You have 20 million in sales, 20 million in total sales, and 8 million of those sales you're shipping overseas. Okay, you have an opportunity to form what's called an IC disc. Now, a couple criteria. First off, the product that you manufacture, the raw material that goes into the product that you manufacture, has to be a United States product. It has to be something that you purchased from the United States. For example, if you import all of your steel to manufacture a product in the United States, then you don't qualify for the IC disc. But if the steel that you use to manufacture a product, it comes from Blanox, or it comes from somewhere in Pennsylvania, or somewhere in the United States, you can qualify for the IC disc. And what the IC disc allows is, if you have those foreign sales, you can take a tax deduction for a commission expense. And there's a statutorily provided calculation to determine what type of commission you're allowed to deduct. Basically, what you're allowed to do, you form a company, it's called an IC disc, and the IC disc pays 0 tax. And it's in the Internal Revenue Code, it's okay. The IC disc pays 0 tax. You pay a commission based upon a formula to the IC disc, and you take an ordinary tax deduction for that. The IC disc doesn't pay tax, but it takes the money and issues a dividend up to the owners. So effectively what you're doing is you're taking an ordinary tax deduction, which could be as high as 39.6%, moving it over to the IC disc, paying a dividend, which is the dividend rate could be as low as 15%. So basically what you're doing is you're taking a tax deduction, including the income. Your taxable income is the same number, but it produces a difference in the tax rates, and it could be as high as 20% depending upon who the shareholders are. This is something we've seen a good bit. We've recommended this to some of our clients over the last couple of years. Again, there has to be, you have to fit into the right criteria, but it's definitely something there to provide some tax savings. So if you're shipping overseas, you manufacture a product here in the United States, talk to us and we'll determine whether something like this makes sense. Looking forward to 2017, the tax savings, assuming that the tax breaks are coming, tax reform will be coming, the tax savings would not be as significant as they would be this year. It's too late to do it this year, but it's something to think about going forward. Going forward, because I've already thought about it, you could still save somewhere between 13% and maybe 18%. So if you have $10 million of foreign sales, and you're still saving 13% of that, it's definitely worth doing. And to prove to you that it's legitimate, there's an article in the Journal of Accountancy this past month about IC discs. So it's definitely legitimate. You just have to make sure it's being done properly. This strategy works very well for C corporations, but it's even better for pass-through companies. Because for a pass-through company, you form the company and it's a subsidiary of your S corporation or your partnership. So basically, you're paying it down and it's coming right back up. Cash doesn't even have to leave the company. Okay, next issue. I deal with a lot of people who have had transactions. When I say transactions, they've sold their business. I do a lot of M&A work. I've done a lot of M&A work over the last 15 years. I run into at least 2 or 3 cases a year where somebody calls me or somebody reaches out to me. I get referred to somebody, and it's like, hey, I just sold my business, or I sold my business 6 months ago. Help me with the tax consequences. Whenever there's going to be a transaction, You need to make sure that as the individual is planning, that as soon as you know there's going to be a transaction, before any of the paperwork's even signed, before you close the transaction, you need to think about the tax planning opportunities that will result because of that transaction. First off, timing of your state estimated tax payments. Let's assume I sell my business on March 1st. Okay? Your CPA sits down with you, does a calculation, say, okay, you're going to owe the federal government $300,000. We're not going to pay that until April of the following year, right? Which is a good idea. If you can keep the money in your bank account, you want to do that. So you're deferring the payment for 13 months. From a state tax point of view, you probably don't want to do that because you have the big taxable income in 2016, for example. You want to take the tax deduction for that fourth quarter estimated payment in 2016 because you're going to get a bigger bang for your buck, right? You're going to be taking that tax deduction against higher income, which is generally taxed at a higher tax rate. If you defer it and wait until the following year, in a lot of situations I see, most of my business sellers retire because they've made enough money they don't need to work anymore. That second year, their taxable income plummets. It goes from $1 million in year one to $100,000 in year two. So your tax rate is much lower in that second year. So that tax deduction doesn't offset taxable income at the same tax rate. The other thing is, with alternative minimum tax, in that second year, you're probably going to be subject to alternative minimum tax. Because if that payment, for example, is $100,000 and your taxable income is only $100,000, you're going to be an AMT and you're not going to be able to take that tax deduction, so you just wasted a $100,000 tax deduction. I see that 2 or 3 times a year when I get called in to help people plan for transactions. So make sure that we're thinking about that in advance when we know that there's a transaction coming down the road. The second thing that's important is the liquidation of the business. Most of my clients that are selling businesses, they're actually selling the assets out of the business. So let's assume I sell the assets out of my business. The business shell still exists. The timing of the liquidation of that shell company is very important. Most of the time, you're going to keep that shell open because you might have a note receivable, you did an installment sale, so you might be collecting those proceeds over the next couple of years. It's very important to be on top of the timing of the liquidation of that company. For example, I don't want to receive my last installment payment in 2016 and then wait until 2017 before I liquidate the company. And the reason for that is I'm going to have a timing difference. I'm going to get kicked in the backside because I could have a capital loss in that second year. And when I have these transactions, it's not infrequent that when you liquidate the company, you have a capital loss when you completely shut it down because there are basis issues there. So you might receive, let's assume you have basis of $100,000 in a company. You sell it for $300,000. So you sell it, you have a capital gain of $300,000. You distribute the cash, which reduces your basis. So 100,000, increase it by 3, decrease it by 3, back to $100,000 of basis. In year one, you have $300,000 of gain. You liquidate the company in year two, you still have basis of $100,000, you have a capital loss, and you have nothing to offset it with. So the key there, I'm sorry I went through those numbers so quick there in my head. So the key there is make sure you're thinking about the liquidation of the company to make sure you're matching up the potential loss with the taxable income. What you need to do is several years of tax projections there. You need to know what your taxable income looks like this year, the next year, and the following year if that deferral goes out for a couple years. Next topic, ways to attract an IRS audit. IRS audits are way down because they don't have people. In general, they're way down when you look at total numbers. But we've had quite a few IRS audits because they're now looking at clients, a lot of clients that we serve. Small to middle market clients that are pass-throughs, small to middle market clients because they're starting to concentrate on those more. Here are a couple ways to attract an IRS audit as an individual. Unreported income. Make sure you understand the matching. Okay? The IRS takes your tax return and they match it with the 1099s or the W-2s or whatever to make sure that if there's a 1099 with your name on it, that number is reported on your tax return. Okay, so matching is very important to the Internal Revenue Service. That's all computer generated. If you have year after year after year where you're not reporting that, you're going to go through an audit. Net operating losses from pass-through entities. If you have pass-through entity investments and you continuously have losses year after year after year and you're taking those losses on your return, you're probably going to have somebody calling you. They never call you. You're going to get a letter from the IRS. It basically says, greetings, you better call Johnston because we've got a problem. Rental loss reported in a year with no rental income. If you have losses year after year after year, rental related, they're probably going to think it's a vacation home, and you're going to get a letter that says greetings. Excess charitable contributions. If you make $100,000 a year, year after year after year, and your contributions year after year after year are $46,000 a year, you're going to get a letter from the IRS. It could be completely legitimate, but it doesn't make sense. They're going to try to, they're going to ask you questions. They're going to say, how are you making $100,000 of income, spending $46,000 in charitable contributions? How are you living? Zero compensation for S corporations and officers. You have income year after year after year as a pass-through, but you're not reporting any compensation income. IRS notices, Pennsylvania and other state tax notices, we see them constantly. When I get back to my office tomorrow, there'll probably be 3 more sitting on my desk. We are constantly getting IRS notices. We're constantly getting tax notices from the states. It's not because of something we did. It's because their computer systems are completely screwed up, and they have a lot of problems following tax returns. If something is not exactly how they think it should be, they're going to send you a tax notice. At least they're going to send you a notice of adjustment. So make sure you're talking to your CPA. Make sure you're talking to us. 99% of the time, we get those resolved with a letter or 2, sometimes 3, and a phone call, or 3 or 4. We can address them. We just have to make sure we have them in front of us, and we have the information. The very last topic before we finish, because I want to make sure I finish on time. Pennsylvania is going to have a tax amnesty program that's starting in 2017. It's going to run for 2 months from April 2017 through June of 2017. If you have any clients or yourself or the business, if you have Pennsylvania problems, if you haven't paid your Pennsylvania tax in a number of years, now's the time to do it, because there's an amnesty program. If you fit into amnesty, which a lot of people would fit into amnesty who haven't paid their taxes, if you fit into amnesty, it's going to benefit you to come forward, tell them, disclose the information. They will eliminate all penalties and fines, and you only get hit with 50% of the interest. Mike Weber and I, who's somewhere here, we have a client that has been collecting sales tax for 10 years. They never remitted a penny. We think the liability is about $200,000. Now, 3 months ago, our options were voluntary disclosure and hope for the best. Now, we're going to wait until 2017. Hopefully, we make it until 2017 before we receive a tax notice. And we think that $200,000 liability is going to end up being about $60,000 because of tax amnesty. So the program is out there. It's not official. It's somewhat official. It's going to be out here in 2017. And that's all I have. If you want to boo, hiss, and throw stuff, now's the time to do it. Thank you very much for your time. We're going to take a 10-minute break, I believe. 10-minute break, and then we'll get rolling again. Thank you very much.